Good day, everyone, and welcome back to our lessons. This is lesson number 24. Today, we're going to be starting a new chapter, which is chapter 6, costing and pricing. And today's lesson, we're going to be talking about costing your product or your services. How do you cost your product or services? So, today's lesson will be covering page 247 to 258 on your Finance and Media textbook, 4th edition, published by Edge Education. Please click in on the link that is provided below to gain more understanding and practice in terms of costing and pricing of services and products. It is always important that you attend your classes regularly and participate in class. Make sure that you engage with other students during class activities, as well as to complete textbook activities covered in each and every lesson, including the current lesson. So today's lesson outcome is that we're going to be covering costing of your product as well as of your services. So by the end of the lesson, you need to be able to understand what are production costs, what are non-production costs, understand the periodic and product cost, understand additional costs such as the sunk, controllable, uncontrollable, and opportunity cost. So those are some of the costs that you have to understand by the end of the lesson. So our lesson outcome was going to, or our lesson outline, we are going to start first by identifying what are costs, as well as how do you put down your production cost, and then we're going to move to non-production cost, and then we're going to differentiate the two types of cost under periodic and product cost. So costing and pricing. So when it comes to costing and pricing, this is a very much practicable concept, because most of us, we see this on our day-to-day life, and we get to experience this most of the time. When you've got something that you bought for a specific price and you want to get rid of it, you just put a price. So most of the time, if you bought something for 10,000, then when you want to sell it, if the item have already shown some wear and tear in terms of losing its value, then you're gonna put a value that is less than what you bought it for. But if the asset is still in a good condition and much better condition, and the price have been inflated, now it's no longer costing 10,000, it's costing 13,000. So you're gonna put yours at somewhere around 12 or 11.5 thousand, so that you can at least make a profit of 1.5. So that is already costing and pricing that we're actually doing. So under this lesson, we're going to be taking a look in terms of a company and how do they price their product or services, which will also assist you in the future if you find yourself actually having to actually determine the services, the cost that you're going to render for your services. So in terms of costing your product, so in terms of costing your product, it says that it is it is every business prerogative to determine the total cost in producing the product it wishes to sell, or the services it wishes to render to other parties. So the business success is determined through the way in which the business determines its cost of its product. So if you determine the cost of the product wrongly, this can end up badly for the company or end up good, but most of the time we end up making wrong decision because we are using wrong information, because the price of the product was counted or was actually developed in a wrong way. So under this lesson, we are going to learn actually how to properly cost a product or a service. So in most cases or in most industries, there are minimum, when it comes to services rendered, there are minimum service fees as well as maximum service fee that governs each and every sector. I'll give an example through the lawyers to say that under lawyers, they are allowed to actually, or advocate, they are allowed in their practice to charge you anywhere between 500 to a maximum of 1.2 to a maximum of 1,200 per hour. So the thing meaning that his preparation for your court case the hours that you use for preparation is gonna charge you for that, and then it's also gonna bill you again the hours that is gonna stand in the court with you and arguing on your behalf for your court cases. So meaning that for each and every hour you spend is going to charge you a specific service fee depending on the type of case you have. So it comes to servicing fee, we've got a minimum fee you can charge and a maximum fee you can charge. So in between, all the fees will be determined by the difficulty of the job. So if the job becomes more difficult, also expect the service fee to also be very high. So service fee are not constant and they always changes depending on the job, unlike product cost. So when it comes to product cost, most of the time these one are constant because the production of that particular product, whether it is sold now or later on, the product cost will remain the same, meaning that we have spent the same amount. Even if material went up of producing that product, but since we produced it previously before the material went up, it will still be costing us the same as what we already expended in terms of producing the product. So here it says that the cost of the product can be classified into following category. If we're talking about the cost of a product, we're going to talk about production cost as well as non-manufacturing cost. So production cost refers to our manufacturing cost. If you remember, under our budget, we talked about master budget, that under master budget, we prepare an operational budget, where under an operational budget is talking about the operation of the business, and one of its budget is the production budget, where under this production budget we then talk about costs that are involved in manufacturing the product. So in most cases when it comes to a product, there are a number of costs that we can actually get to incur for on producing a product. So most of the time I'm just going to make an example here, and then when we move forward, then everything will just be much easier to understand. So assuming or making example of producing a table chair. So if we're producing sorry about not a table chair, I will say a wooden chair. So let's say that we are producing a wooden chair. So when producing a wooden chair, so what will be required is that we're gonna require the following material. We're gonna require wood, we're gonna require steel to connect to make the legs. We're gonna need screws to screw the wood and the steel together. And then I think let's just assume that this is all we need. And then for this to actually be a complete product, we're gonna need something else beside material. We're gonna also need labor, which will be the person who's going to use to convert all of these products to a final product. So maybe our employee is a semi-skilled employee. And then we're also gonna need a machine or machines. So here I'm just gonna write machine, and the machine is gonna need electricity. So if we're going to produce this current product that is here that I've mentioned here, so when it comes to costing the product in terms of producing this wooden chair, so this wooden chair will be all the cost of this product will be based on the cost that we expended in terms of the production of this. So all of this will form part of our production. In terms of non-manufacturing, we're gonna need a supervisor, and then we're gonna have administrator. So we're gonna need administrator, and we're gonna also rent offices. And then here we're gonna also rent space for factory. Rent factory that we're gonna use for production. And then here we're gonna have sales personnel. So these are all the type of cost we can incur in producing a product: non-manufacturing and production cost, assuming that we are going to be producing this chair. So what will actually happen is that this will be the materials that you're gonna need. So you might find that one wood to produce, or the number of wood that are needed to produce a chair, it's 3 kg of wood, and the cost of this is actually 2 rand. So meaning that to produce one chair is going to cost us 6 rand. And therefore, in terms of steel, we're gonna need 1.5 kg of wood of steel, and therefore each is costing us I will say 4 rand, or it's fine, let's keep it at 5. So this means that if steel is costing us 5 rand per kg, so therefore the following will be the cost per chair, which is going to be 1.5 multiplied by 5, giving us 7.5. And then in terms of screw, it needs, let's say, 8 screws, 8, and each is costing us 50 cents. So therefore this means that for 4 of them we're going to cost 4 rand. And therefore in terms of material cost, the total will be 17.5. So meaning that this is the cost for producing, this is the material cost for one chair, for one wooden chair. And then in terms of labor, for this person to produce one chair, it takes him actually 10 minutes. I'll say 10 minutes. And we pay him, for example, 30 rand per hour. At 30 rand per hour. So this means that when it comes to this 10 minutes, we are going to pay him his 10 minutes, and we're paying him 30 rand per hour. So when we pay 30 minutes for one chair, this means that we're going to say 10 out of 60 multiplied by 30. So when we say 10 out of 60, we're converting the 10 minutes into hours, and then multiply this by 30 rand. So that will be 5 rand. So meaning that now here we are going to have to pay him 5 rand per chair he produced, because it takes him 10 minutes to produce, and we pay him 30 rand per hour. So meaning that per chair we are paying him 5 rand. So this is just an example. And in terms of machine usage, this person will be using these machines to actually run. You'll be using machines to be able to convert steel into a shape that you will need. You to also cut wood, and then it's gonna use a machine to screw in the nuts, or the screw in the bolts, so that the chair is very stable. So when you use the machine per hour, for every 1 hour, or let's say per chair, it takes him again 10 minutes, and then we are actually paying electricity cost at 1 rand per hour of usage of this machine. So this is just gonna be the cost. So I'm just making an example. So that means it's going to be 10 divided by 60 multiplied by 1. Let's not use 1. So here let's use a different figure, so that it makes a bit of so that we don't run at a fees that are not gonna be good. So I'm just giving an example of this whole lesson in one slide, so that when we move forward it becomes much easier. So here we are saying that it's going to be at let's say it's gonna be 10 rand per hour. So let's calculate the value of that. So that's 10 divided by 60 multiply by 10 rand. So that will be 1 rand 60 cent, 67 cent. And then rent for factory, we're just not gonna include it here now yet, so I'm just gonna stop here. So let's assume that this one is included here under the rent for the whole building and offices, and the factory all are combined in here. So let's just say this is only what is involved in the manufacturing process. So in total, so we are going to have 17 rand 50 cent plus 5 rand plus 1 rand 67 cent. So meaning that the total production cost of this product becomes 24.17. So this means that if it cost you this much to produce this one wooden chair, so this will be our production cost. So to be able to determine all of these figures that you are actually seeing here, to be able to determine all these figures that we'll be seeing here, so this will become the tricks, because most of the time for us to determine this, we need to have already produced a number of chairs, or at least a number of chairs, to be able to identify the number of kgs that are used in terms of wood to produce a specific chair, and how much per kg of wood do we actually buy it for from our supplier. In terms of steel, a chair requires 1.5 kg. This is after we've measured the number of kg of steel that was used to actually create one chair, and 1 kg of steel cost us 5 rand, so meaning that for this chair it's gonna cost us 7 rand 50 cent. Screws are costing 50 cent, and therefore we need 8, so that's 4 rand. So in total the material cost per chair is 17 rand 5 cent. So this will normally be your what you call production cost. So this is now what you call the production cost. So this will be your production cost. So while this is your production cost, then you can therefore be able to identify your selling price through the production cost. You can be able to then determine what is going to be my selling price based on the production cost. But when you determine your selling price, so you're gonna add what we call a markup percentage, which is gonna include, so a markup percentage includes two things. It includes your non-manufacturing cost inside it, and it includes your profit, the profit that you are going to make out of this product. So in terms of all these manufacturing cost and non-manufacturing cost, what most of the time we end up doing is that we combine all of this under traditional method and divide them by the number of units produced. Let's say for example number of units produced are actually 10 rand per chair. So meaning that in terms of the total non-manufacturing cost divided by the number of chairs that were produced, it's actually equivalent to 10 rand, and therefore now we need our profit. So our profit, we can say let's double the profit of what we actually spent on the product, 24.17. So this means that our markup is going to be 34.17, and when we add it to there, it's gonna be 58.34. So this will be our cost of, this is going to be our selling price. So this is the selling price. So this is how you get to determine the cost that will lead you to determining the selling price. So in terms of markup, as I mentioned, that markup will include non-manufacturing and profit. So in some cases, some will go and say our markup, let's add 150%. So this means that we are doubling the price and also adding 50%, meaning that the other double of the price might be able to cover all of these expenses. So we don't just come up with this 50%. So when we come up with the 150%, we determine it through the following method. So from this method that we just make, we can go and say 34.17 divided by 24. This will determine our markup to say that now we have got 34 inclusive of our profit. These are additional cost plus profit. 34.17 divided by 24.17 multiplied by 100. So this will equal to 140. So here we are saying for markup, sorry about that. So markup, we are saying it's equals to 34.17 over 24.17. This is our non-manufacturing cost plus the profit that we want to make for this product. So that will give us 141.37%. So we can just then say 150%. So meaning that for each and every chair that we're going to manufacture, if the cost of the chair goes up, therefore we expect to add a markup of 150%. So this is how markup gets to be determined. So meaning that if next year the cost of material goes to 20 rand, If it goes, this one goes to 20 rand, and this one goes to 7 rand, and this one goes to 2 rand. So that is going to be 20 plus 7, then it's going to be 29. So meaning that when the cost becomes 29, what we are going to do, uh, we're going to add 150%. That is going to be to multiply by 2.5. So therefore, our selling price for this product, the new selling price will be 72.5%. So this is the same as multiplying this by 150 first and then add the 150 on the 29. So instead of doing that, I just go and say 150 is the same as 1.5. So if I want to add 1.5 to something that is already a whole, which is 1, so I'm just gonna be 1 plus 1.5. This is gonna give me 2.5. So this is how I did get the 2.5. So this is going to be the new selling price. So when it comes to costing your product, so you need to be able to identify the costs that are relevant in terms of the manufacturing of the product. Once you have got those costs, then you're gonna also be able to identify the manufacturing costs that are going to be these ones, non-manufacturing cost, and you're going to allocate your non-manufacturing cost per product to be able to determine how much per product did you manage to spend in terms of production, and therefore you're going to add your profit, then determine your markup percentage, and then that markup percentage will be used all the time. Even if the cost goes up, you know that your markup is also going to cover the cost, it's going to cover all your non-manufacturing cost as well as the profit that you actually want to achieve on your product. So therefore, this is what this whole lesson is going to be all about. So the lesson is all based on being able to identify all of these costs and then also being able to put a price on your product. So before you just sell something, understand the costs that were involved in buying the assets, bringing the assets to your store, and then you can add up all the other additional costs that will be involved in making sure that the product gets to be sold. So here it says that the production manufacturing cost is mainly focused on three elements, which is the direct material, direct labor, and manufacturing overhead, which I just shown you in the previous example. So you're gonna have to determine all the costs that are associated with manufacturing a single product. If you are not able to do so, and you manage to produce 10,000 units, and for material cost, this costed you 2,000, labor 1,000, variable overhead, which is electricity, it costed you 500. So in total the cost was 3,500. So therefore, to be able to identify your total production cost, you are going to add all of these. So your production cost is going to be 3,500. So that will be your production cost, and therefore production cost per unit, it's going to be 3,500 divided by number of units produced. So this time we produced 10,000 for this much, so therefore your production cost is going to be 3,500 divided by 10,000 units. So this means that it actually costed you 0.35 cents. It costed 35 cents for you to produce one unit. So therefore you can add your markup of 50%, and therefore your product will be sold for either 2 rand or 3 rand. So this is how those product of 1 rand gets to be identified. Say this is the cost, this is the plus the markup. So you're gonna also be able to identify the markup once you know your non-manufacturing cost. So if you cannot allocate the cost per product through the previous method that I show you. So this is the method that you get to use to be able to identify your production cost. So all you need to take a look into is your direct material, direct labor, and manufacturing overhead to determine how much you are actually spending per product. So your direct labor will include the price that you pay for the person who's going to be operating the machines to actually produce the specific product that you are producing. and then the material used will be the cost used to produce that. The overhead will include your electricity consumption, will include the machine setup cost. If your machine have to be set up every time it gets to be used after repair, then you're gonna hire a person to actually come in and actually uh, do the setup and leave. So the cost that you're gonna be charged for that will also form part of your manufacturing cost. So when it comes to manufacturing cost, if the cost is not involved, so what you actually determine is you have to identify whether this cost is was incurred because of the manufacturing of the product or not. If the cost was not incurred because or it was not incurred as part of manufacturing the product, it becomes a non-manufacturing cost. For example, salary of a supervisor. So a supervisor cost, even if that person is not there, the product will still be produced. It's just there just to make sure that things run smoothly, not that the product gets to be done or not done if it's not there. So therefore, that qualifies it as a non-manufacturing cost. So this is how you get to classify whether the cost fall within manufacturing cost or non-manufacturing cost. And in terms of material, here it says that materials. So here it says that materials refer to the material which can be traced directly to a finished product. And when manufacturing a wooden chair, the wood used in the production process is regarded as the direct material. So it is important to note that direct material will be variable cost because it will increase in direct proportion to the number of units produced. So therefore, meaning that the more of number of units we produce, this cost will actually go up. So we classify that as a variable cost. It varies with the number of units produced. And then in terms of direct labor, this refers to the cost incurred to remunerate workers that are directly involved in the manufacturing process. So the direct labor is often called touch labor. So since the direct labor workers usually touch the product while it is being produced, so the direct labor is always a variable cost because an increase in the number of units will be accompanied by the similar increase in the cost of direct labor. So this person, if he's the one involved in the producing of this product, if you produce one product, we're gonna pay him a certain rate for producing that product. The higher the number of units, the higher the payout will be, and the lesser the number of units, the lesser the payout will be for this person. So this means that this also becomes a variable cost because it varies with the number of your most of the time it varies with the number of units produced. An example of direct labor cost will be the remuneration of the builder on a construction site, a carpenter for making a wooden furniture. And then we've got manufacturing overhead. So manufacturing overhead are those type of costs that we incurred that cannot be fully traced to one specific product, but we can only be traced the full cost to the total number of units produced and then transfer it to the per product to say that electricity cost. Most of the time we cannot calculate electricity cost directly straight to one product, but what we know is that we're gonna have electricity consumption. From electricity consumption, we're gonna then have the total cost of electricity. And then from that total cost of electricity, we can determine that we use 10,000 rand electricity and we produced 50,000 units. So that means that we are going to say 10,000 divided by 50,000 units and see how much each unit was actually costing us in terms of electricity. So that's how you can be able to uh, place the manufacturing overhead cost straight to a product. So here it says these are the following costs that could be included under the manufacturing overhead. We've got indirect labor. So indirect labor is someone who comes and set the machines and then leaves. So those will be the type of guy. Indirect material, things that are the materials that are used after the product is already complete, things such as furnishing the product, the cost of the painting, all of those. So those are extra additional costs that will not be but painting will mostly will form part of the material that will be needed to paint the product so that it becomes complete. So we also have got other indirect material that will be used by the person to actually get to make sure that the product is complete, and they are not there on the machine. You cannot see them on the machine. Maybe other materials that are involved in setting up the machine or that are required by the machine. And then we're going to have rent paid. So rental paid for factory will also form part of the manufacturing cost or manufacturing overhead. Maintenance on the machinery and equipment used in production. depreciation of a factory equipment, but most of the time this one, if we don't actually get to include it because it's a non-cash item, and sometimes we tend to say that it's irrelevant for decision making in terms of calculating the production cost, because we do not actually get to see its value. But in terms of maintenance, this cost will be reflected under the maintenance cost in most cases. And then we're going to have water and electricity used in the manufacturing process, insurance paid on the factory plant. So all of these are manufacturing overhead. So they are costs that are assisting us in being able to actually produce the product. And from that point, we can be able to classify them as manufacturing costs. And then in terms of non-production costs, these are your non-manufacturing costs. These are costs that are used in the office that are outside of the manufacturing process. Things such as your administrative and marketing, distributing, and selling costs. So those are the two types of categories we have under non-manufacturing cost, where your administrative costs are all organizational, executive, clerical costs associated with general management of the organization. Example will include insurance, water and electricity for office uses, wages of our sales rep, our administrators, people who work in the stock room to buy stock. So those will be their salaries, cleaning materials, and etc. And then in terms of marketing, distribution, and selling costs, this include all costs necessary to secure a customer order. So this include your advertisement cost, this include your sales personnel salaries, and this also include carriage and railway costs that you're gonna transportation cost from the warehouse to our retail shop. So those will be the non-manufacturing costs that we're gonna incur. So all of these non-manufacturing costs that we're seeing here, they just assist you in terms of being able to either produce the product as well as to sell it. So therefore, when you determine the selling price, you're gonna take them into account after considering the selling price, after considering the cost of the product, which is coming from cost of production. So all of this now leads us to what we call product cost and periodic cost. So in terms of the two type of cost, we've got product cost, which are costs that are incurred to manufacture a product that will eventually be sold and are recognized as an expense only when the sales take place. So the product cost becomes what we call cost of sales. Cost of sales once the product gets to be sold. And then here it says product cost consists of direct material, direct labor, and manufacturing overhead to manufacture a goods. And periodic cost are all the costs which are not included in the product cost. So all the costs that would include there, we're gonna call them periodic costs. So normally periodic costs are fixed in terms. So these are classified to be fixed, so meaning that they remain constant over a period of time. Things such as factory rent, we expect it to remain constant. Rent for offices, things such as salary of administrator, they will be paid the same amount. Whether number of units increase or decrease, they'll still get to be paid the same amount. So those are what we call periodic cost. They remain constant over a period of time. So all of these costs are not included in the production cost. So here it says that product costs are not included in the cost of goods sold or good manufactured or purchased. All selling and administrative costs are periodic costs and will never form part of manufacturing process. So if you're working with a retail, we're not gonna have production cost. We don't have this. We're just gonna have uh, purchase cost. And your purchase cost, when it comes to determining the cost of the product under retail, cost of a product, this will include the purchase price, transportation cost. If the goods have to be configured, this will also include configuration cost. So all of these will then give you the product cost. So this is under retail, where you are buying and selling something that you didn't actually produce. So the purchase price of that product and the transportation cost of the product to be delivered from a supplier to your cost will form part of the product cost, and then the configuration if the product have to be configured before you sell it, so that will also form part of that product cost. And then from this point you're going to have your product cost. After product cost, you're going to add all your periodic cost, which are your non-manufacturing cost, which we believe that they will remain fixed over a period of time. Then you're going to also add your profit, and then we're going to have the selling price. So, but all of these can be used under the markup. We can calculate the markup that we're going to use to say each and every time, even if the prices changes, our production cost will add a markup of 150% to get the selling price of the product. So this is when we're working with retail. This activity or this lesson was normally based on production, but I also added the retail so that you understand how do the retail actually come up with a selling price. In case if you are going to open your own media business where you're going to be selling media materials, so this is how you're going to be able to determine if you're not going to manufacture the selling price as well as the product cost. So your product cost will include the purchase price, transportation, configuration, and then you're going to have your total production price per unit or per bulk in terms of all units, and then you're going to add your non-manufacturing cost and then your profit, and then from there you can calculate your markup that you will use from the next period going forward. That I'm always going to add a markup of 50% so that it covers the profit that I require as well as the non-manufacturing cost or non-related purchase cost. So we do have other types of costs that are involved in terms of running a business. So we have got uncontrollable costs. So these are costs that the manager do not have control over. These are things such as the cost that you're gonna incur when you go and buy from the supplier. So some of the time we call that these are uncontrollable market price. So we'd say that these are uncontrollable cost. Opportunity costs also falls within there where customers do not want to come and buy. So most common uncontrollable costs, we're gonna have things such as tax and municipality rates. So these are uncontrollable costs because these are governed by other people. So costs that are governed by other people or that we have to pay them. So we call them uncontrollable costs. So when we get to assess in terms of the profitability of the company, how everything is running smoothly in terms of whether we manage to price the product right and if we're going to make profit. So some of the things that will affect that will be those uncontrollable costs. And then we also have got controllable costs, where controllable costs are those which the manager of the company have got control over, such as the minimum wage that is supposed to pay his workers, his administrators, all internal costs that the company will incur trying to manufacture the product. So all of those we have got control over. So therefore, we're going to classify them as controllable costs when it comes to decision making. And then we also have got sunk cost. So sunk costs are costs that are already been incurred, which cannot be changed by any decision now or in the future. For example, if we bought material that are worth 1,500, the material is 10,000 kg of wood or 1,000 kg of wood. So if we are going to have a special order to produce 500 chairs, and these material are enough to produce these 500 chairs. So when it comes to decision making, the cost of this 1,500 becomes irrelevant for decision making because we already have got the material. So what we need to consider are other costs that we are going to incur to produce these 500 units, and then we're going to compare this with the money that we're going to bring in and then say that these are all relevant costs. So sunk cost becomes irrelevant for decision making. So therefore, when you get to make decision in terms of your production cost, in terms where the material are already available, so those costs will be classified as sunk cost and therefore will be irrelevant for that decision making. Because whether you take this order or not, these costs are already incurred. This decision will not change that. So therefore, you're gonna only consider things such as your your steel cost, your screw, your labor cost, your machine overhead cost. So all of these will be considered here, and then you're gonna put the price here, and then here you're gonna put the revenue that you're gonna receive. If it's negative, decline the project. If it's positive, then accept the project because you are going to make more money from this special order. So that's where we get to use the sunk cost. And then you've got your opportunity cost. Opportunity cost is when this material are supposed to be used on normal order. And when we use it on normal order, the product that we are going to use it for, it's actually going to allow us to generate a revenue of 1,000. But let's just say that since these are used on normal order, the cost to replace this is gonna be 2,000. If we use them on special order, we'll have to replace this 1,000 material for 2,000 by buying the new one for 2,000. Therefore, the relevant costs or opportunity cost under here will be the 2,000 that we are going to actually get to buy the new material for. So that becomes the relevant cost. So in terms of opportunity cost of this will be the profit that we're supposed to make over there. To say that let's say we don't have capacity, we use the 1,000 to produce the special order 500, and then we do not produce the normal product. So therefore, if we're supposed to make a profit of 10,000 on a normal product, and then with the special order we are going to make a profit of 9,000. So this means that we are going to lose 1,000 from this. So this becomes the opportunity cost, to say that we could have earned 10,000 if we use the 1,000 kg to produce the normal product, but instead, since we don't have capacity, we are accepting the order and produce the order. So therefore we will generate a profit of 9,000. So this means that the 10,000 becomes the opportunity cost that will be considered in terms of the decision making for the special order. This means that we are going to decline this new order because of the opportunity cost is higher than the special order revenue. So here it says that opportunity cost is the cost of the next best alternative not chosen when a choice is made, choosing to study and giving up the opportunity of working. So the opportunity cost will be the salary given up. So it becomes the cost of something that we didn't actually get to do. So this is what we had to cover in terms of the product costing and services rendered. So one of the concepts that I didn't explain is when you're actually trying to come up with a service fee. So service fee you're gonna have if you are having working on an industry that have got a minimum rate, for example, journalism. They will tell you that per hour you can charge between 200 up to a maximum of 1,000. So this is not only what you can actually charge, so meaning that your price is given from 200 to 1,200 depending on the type of service you are going to render. If let's say for example you are going to a VIP conference where there are going to be very important people and they are going to be discussing matter of a country or matter of a bigger investment project, you have to actually go there and take a report, or in terms of make a report, ask question on behalf, let's say, of SABC. So what will actually happen is that when they hire you as an external or as a freelancer to go and do the report for them and a journal for them, so when you determine your price, let's say for example they are hiring you because the conversion is where it's at Centen. I'm just gonna use the same example I used in class, that it's in Centen, and then is not far away from you, so meaning that your cost, so when it comes up to the fee that you're gonna render, since it's a VIP, you're gonna charge almost somewhere in terms of the service fee, to say that just because of VIP I will have 800, because you will have to ask tough question, get more insight of the knowledge, use your own knowledge, your skills to be able to get more information of what is going to be achieved by the end of this conference. And then you're gonna add your transportation cost to the event. Let's say it's 100 rand, so you're gonna have your 100 rand here. The conference is gonna take 3 hours, then you're gonna need food for 100 rand, so therefore your total billing will come back to 1,000. So this is how you come up with a service fee. So when you get to charge them, so you're gonna add what we call a standard service fee based on the level of job that you are required to do. Then you're gonna add your transportation, your beverage, because you're a journalist, you need to eat there. Therefore, your total service fee will actually be 1,000. So this is how we get to determine a service fee for a service that is going to be rendered. Same way when you take a car to service. So this is how they are going to determine their service fees, to say that to change the oil, the person who's going to work there will be paid 500, and therefore the equipment that will be used will also be having wear and tear, meaning that they will be losing value or losing threads. So therefore we're gonna charge you at least 900 for that. So already that's 1.5. So meaning that they are going to be charging you 1.5 for using their own equipment, and the extra labor fee for the person is going to service your car. And therefore, if there are additional parts that are going to be needed, they're gonna put that as well, and also put their own markup. So if a product is costing, let's say for example, they are already charging you 1,000 just to replace the stuff. If this stuff is costing 300 and you're not bringing it, because they are going to buy it and require it to be transported, they are going to add 50 rand. So therefore you are going to be ended up charged 1,850 for a service, including the part that they bought and put in place for you. So the 50 rand is their transportation fee, or their charge for actually buying the product on your behalf and getting it transported and making sure that the product is the right product. So you end up paying 1,800. But if you bought the product, so your cost end up being 1,800. So this is how people get to determine the service fee in terms of when you're going to render a service. So I hope this is very helpful. So in terms of activity 6b that you have to perform, please go and perform activity 6b. So what is happening under activity 6b? You are given periodic cost. You have got your periodic cost, and you've got your product cost, and here you have been listed, you've got information listed. So with all this information listed, you actually have to identify whether this type of cost is a periodic or a product cost. And then if it's a product cost, they're gonna give you direct material, direct labor, and manufacturing overhead. This side they're gonna give you marketing, and this side they're gonna give you administrative. So let's say for example, I think they talked about something that is used to manufacture, that is used to convert that material that is used to make a plastic. So that material, because they're making plastic, it's gonna come under direct material. So the cost of that, you're gonna put it here if it's 10,000. And then the second one, they'll be talking about labor of someone who's actually producing the product, and therefore you're gonna come under, say that this is a production cost, it falls here and it's 10,000 as well. And then they're also going to tell you about salary of administrator. So that is going to fall here, to say that this is 6k. So at the end of the activity, you're going to write to say how much is your direct material here, how much is your direct labor, how much is your overhead, and then how much is your administrative, how much is your periodic cost. And then all of these combined will give you your periodic cost, and all of these combined will give you your production cost that you will use to determine the price of the product. So this is what this activity is actually showing us there. So please take a look into it. If you have got questions, please send me an email, I'll be able to help you. So this is the end of our lesson. So our next lesson is going to be a revision of chapter 5, which is going to be our cash budget and working capital. So once we are done with this lesson, then we'll be able to understand everything that is going to be happening on your assignment. So I'm going to make a recording for this revision and then upload it, and then from there I believe you'll be able to write your assignment, because it's covering the working capital and cash management. So please stay tuned for the next recording, and we'll see each other on lesson number 25. Thank you for showing up.